So, how much is an idea really worth? I mean, what if that idea is a half finished patent for a drug? One that could either cure a major disease or just fail completely. Companies have to put a price on these things all the time. And when they do it between their own international subsidiaries, well, it becomes a massive headache for global tax fairness. So, today, we're going to break down how tax authorities are trying to solve this billion-dollar guess.
All right, let's get right into it because this is the fundamental challenge, right? We're not talking about valuing a factory or a fleet of trucks here. We're talking about assets where the future is a total shot in the dark. It's a world of just immense uncertainty, where one single breakthrough could mean billions in profit, and one failed clinical trial could mean the value is, well, zero.
And this right here, this gets to the absolute heart of the problem. It's something called information asymmetry. Think about it. The company is holding all the cards. They've got the internal data, the scientists, the secret business plans. But the tax authority, they're on the outside looking in, trying to figure it all out. And according to the OECD, tackling this huge imbalance is exactly why these new rules were created.
Okay, so we're not just talking about any intangible asset. The OECD has a very specific name for what we're dealing with: hard to value intangibles, or HTVI for short. These are the trickiest of the tricky. We're talking things like patents for drugs that are still in early development, stuff where there are no real market comparisons, and any financial forecast is basically a highly educated guess.
You see, this huge information gap meant that potentially billions in tax revenue were just slipping through the cracks. So global tax authorities, led by the OECD, got together and developed a really powerful and, yeah, some might say controversial new approach to try and level the playing field. Let's dig into how it works.
And this quote from the OECD, it says it all. In simple terms, tax authorities are now allowed to use hindsight. That's the key. They can look at what actually happened years down the road, that's the ex post outcome, and use that success or failure as powerful evidence to challenge the original price that was set way back at the beginning, or ex ante.
And just to make sure we've all got this, let's nail down these two terms, because you're going to hear them a lot. Ex ante is the valuation at the very beginning. It's the guess based on all those forecasts. Ex post is what happens in the real world, the actual sales, the actual profits that roll in over time. The whole HTVI approach is about connecting that initial guess to the final reality.
So how does this actually play out? Well, it's a pretty straightforward process, really. A company transfers an intangible asset and sets a price. A few years go by. The real-world results start coming in. And if those results are wildly different from what they first projected, that's when a tax authority can step in. They can use that actual success as presumptive evidence that the initial valuation was probably off from the very start.
Okay, so that's the theory. But to see how this really works, let's walk through a simplified example, one that's actually inspired by the OECD's own guidance. This should make everything crystal clear.
So picture this. We have Company A, and it's transferring a promising but still unfinished drug patent over to its affiliate Company S. This all goes down in year zero, and they agree on a single one-time payment for all the rights to this patent.
And what's the price tag? They land on $700. This is their ex ante valuation. Now, this number is based on a whole set of projections, and a key one is that this drug is years away from making any money. They don't think sales will even start until year 6. But then, fast forward to year 4, and wow, things look very different. The trials went way better and faster than anyone expected. The drug wasn't just a success, it was a total blockbuster. And sales? They started way ahead of schedule, back in year 3. The reality completely blew the initial guess out of the water. And this is where the tax authority steps in. They see this massive success, and they use it as presumptive evidence. They argue, hey, the possibility of this early success should have been factored into that original price. So they do a revised valuation and conclude that the fair price back in year 0 really should have been $1,000, not $700. So, and this is the kicker, the tax authority can make a primary adjustment of $300. But here's the thing, it's not a new tax for year 4. Nope. The adjustment goes all the way back to year 0, increasing the taxable profit in the year the transfer actually happened. Now you might be thinking, wow, this sounds like tax authorities get a blank check to just rewrite history whenever a company gets lucky. Well, not exactly. The system is actually designed to be a comprehensive solution, with some really important safeguards built right in to keep things fair. The taxpayer isn't just left out in the cold here. They have the right to push back, to show that their original projections were actually totally reasonable based on what they knew at the time. Also, the rule doesn't apply if the success was due to something truly unforeseeable, like a completely unexpected event. And there's even a safe harbor. If the difference is less than 20%, no adjustment is made. It's really about targeting those significant major mismatches.
Now, for companies that want to avoid all this drama and uncertainty, there is a powerful tool, the Advanced Pricing Arrangement, or APA. This is basically where a company and the tax authorities agree in advance on how to price these kinds of transactions. And if you have an APA that covers this HTVI, these hindsight rules simply don't apply. It's pretty much the ultimate way to get tax certainty.
So in the end, the HTVI approach is way more than just another tax rule. It's a really fascinating attempt to solve a core problem in our modern intangible-driven economy. On one hand, it's a powerful tool to make sure profits are taxed where value is truly created. But on the other, it definitely shifts a lot of risk from governments onto businesses. Which leaves us with a big question and a pretty good debate about the line between ensuring tax fairness and just rewriting financial history.